Welcome, viewers, welcome, audience, welcome, listeners. My name is Yara Thompson. I am a thought leader in the accountant industry. I'm a practicing accountant and a tax preparer, and I'm here to share knowledge with you on how you can take advantage of tax concepts, tax strategies, how to get your taxes done accurately, filed on time, and more importantly, gain financial health by assuring your information is transparent and accurate. And with that being said, welcome to my next session. For those who are coming back, welcome back. And in this session, we're going to explore a few things, very important things. So, these things that we're going to cover are going to be how tax preparation differs by industry, right? So a lot of us, as COVID impacted us, the pandemic, we had to become the creatives. For those who already had an established business, some of us had to close our doors. For those who had an established business, we closed our doors but transitioned to a new industry. For those who were working W-2 and possibly got laid off, we had to go into the creative space and create our own and take our passion and make our passion become our day-to-day job, and doing that through self-employment. Well, for that, what we're going to do is we're going to go ahead and discuss what those look like in great detail as it relates to your taxes. So we're going to cover deductions, credits, and the different forms for various sectors. And we'll also look at some tax saving strategies, but in using those tax saving strategies, how it impacts your real world scenarios. So, for example, if you're a cosmetologist, how does those tax saving strategies impact you? If you're a real estate agent, how those real world, what are those tax strategies? And more importantly, if you're just a professional services individual, just rendering services, you are pest control or mobile car wash, how can those tax strategies impact you as well? So as we get started, I'm going to be covering great details of information in our session, and no worries. All I ask is you can always come back and replay the video, but the one thing I need you to do is make sure you subscribe, like, follow, and also comment. It is a free space. Remember, as a thought leader, I am committing myself to you, my listeners, my audience, to providing you content that not only empowers you, but it enables you to create that same thought space, that creative space of reflection, of knowing whether this information is, am I following the right process? Do I need to meet with someone that is in that same space as a subject matter expert to improve what I'm doing? And with that being said, we're going to go into our topics today. So, as a freelancer, of course, can be, as I mentioned, I can be your barber, I can be your nail tech, I can be your carpet cleaning guy. We call those freelancers, right? Those freelancers or small business owner, you can deduct a various amount of things of business expenses. And some of those expenses that we can cover, I'm going to highlight because in every scenario that we cover today, we're going to cover these same expenses, but in a different form and a different tax strategy. And those expenses are, we're going to start with home office. Okay. Home office expenses. So home office expenses, if you work from home and in your home, you are using a portion or a allocated space of your home. And in that home, you're paying a multitude of expenses. That includes rent, utilities, right? It also includes internet. How are you engaging with me as your customer? Now, for a regular consumer, these are three high ticket numbers, right? Because if you followed me on my first video told you the basics of tax prep. And in deductions, by being an individual, you're only allowed to deduct specific expenses. Those specific expenses are related to, I'm going to recap them real quick, are charitable contributions, property taxes, mortgage interest, jury duty. You're going to have also car registration. Those are what the IRS regulation calls or regards to as individual expenses. As freelancers, as small business owners, we're coming into a different game, right? Our mindset now, we're saying, hey, I operate from home. I suffered from the pandemic, or I just work from home that's where I would like, that's my preference, right? But in my home, of the space we're paying rent, huge bulk, utilities, and internet. And that's just the starters, right? The next expense that we're going to look at is your vehicle expense. So for your vehicle expense, let's talk a little bit about that, okay? So mileage or actual expenses related to your business and vehicle are deductible. But then it comes to the line of what is a business vehicle, what is a personal. Can I use my personal vehicle for business and still take advantage of those tax breaks? Well, guess what? That's why we're here, because I'm going to give you that tax strategy, insight on how to apply that tax strategy in your day-to-day operation of your small business, so that then when it comes to file your annual tax return, you're document ready, you're log ready. I have a mileage log. I track my mileage for business. I only have one vehicle, but that does not say that I cannot deduct my business mileage, right? So we're going to cover that. So we're going to cover mileage under vehicle expense, and we're going to discuss personal versus business. All right. At this point, we've covered two major deductions. Out of these two deductions, guess what? There's another big one. The other one is called supplies and equipment. So in order for us to be a craftsman, a tradesman, a subject matter expert, we have to have supplies and equipment in order to produce or provide our service. Okay. But with having supplies and equipment, it just doesn't stay there, because everything has a shelf life. We may have to replace our equipment. What happens to if I purchase another equipment and I reported that I had this one at the end of 2022 and I replaced it with one in 2023? Isn't that considered inventory? And does it have a shelf life? And can I carry over or depreciate the lost value? So many questions, but those questions has answers, and that's why we're here, right? So as we move forward, additionally, you have a huge advantage or favorable credit that many don't take advantage of, okay? I'm sorry, and that's a deduction. That's called a qualified business income deduction, okay? The QBI, qualified business income. And I'm going to put deduction down here so you know it's not a credit. It's an indicator that it's considered a deduction. But important words here are qualified business. Those are important words. Why is that? So what is a qualified business? Means that the entire deduction allows you to, listen to this, deduct 20% of your qualified business income on your business side of your Schedule C or your Schedule E if you're a real estate agent, even before you take it over to your 1040. So I made a profit of, I had a gross receipt of property management of 100,000. Because I am service based, I am a qualified business, I can take a 20% deduction from that 100,000 to include from this 20%, I'm going to deduct all of these. See how the numbers, it's okay to make money. It's okay to profit because there's multiple strategies involved on how to make that liquidity or that profit line work favorable for you as a taxpayer. And how do you do that? Is you're going to by following these tax strategies that I'm sharing with you. And they're very tedious, they're very detailed. They do require implementing streamlined processes in your day-to-day operations, sometimes as simple as adding a CRM or a point of sale system, adding Square. Forget Cash App, forget Zelle. Legitimize credibility, establish your business, establish what you're doing, and do it under your name, right? Because you want to continue to grow. So we've covered 4 things. We've covered our home office expenses, our vehicle expense, supplies and equipment, and your qualified business deduction. Now what we're going to do is we're going to go over to common mistakes. So some of the mistakes that we keep doing is we don't keep accurate records. Like I just touched, point of sale system. So you can have Square offering you free Square card reader if you sign up for a 12-month period. But there's underlining fine print with those, right? So what is Square? Square is considered a merchant processor who comes with built-in fees. So you have to do business, you have to put in money, you have to invest money. So some of these fees, you want to make sure that in a different series as we follow outside of tax prep, we're going to have a discussion about business and how to start up businesses, right? Because you want to make sure that all these fees, your rent costs, your vehicle, your supplies, you're building that in to the price that you're charging your consumer to sustain your overhead. But to the point of this session, what I wanted to make sure is that some of those common mistakes is just not by thinking outside the box. It's taking yourself from complacency and being comfortable, like, I have Cash App, I have Venmo. Send me over that fee by Venmo. Send me the, how did you legitimize that transaction? You haven't. Those are what's called common mistakes. And those common mistakes impact when you're trying to file your taxes. So how do you do that without proper documentation? The IRS might disallow some of your deductions if you do, right? And the disallowance can also impact your self-employment tax. And if it's going to disallow 20% of your qualified business, all of your deduction, 100,000 plus your W-2 job of 60,000, you're paying almost 18% taxes of all of that income. It's not worth it. legitimize, credibility, growth. Those are why we're in business, not just to make them make it through our next rent cost of overhead or get our kids through college, right? That's just the beginning, because you have a long life ahead of you and you have to plan. The only way to plan is to start by these simple steps, right? And with doing that, we're going to now go into our first scenario, okay? We're going to go into our first scenario. So, Sarah is my case study. And Sarah is a graphic designer, okay? So we have, I'm going to change my color to keep the integrity of the topics that we're discussing. So Sarah is my taxpayer. She's a graphic designer. Sarah makes, I can say, I'll say, let's say we'll go with Sarah makes 60,000 as a graphic designer. Sarah does have a home office. Sarah also, I'll say Sarah, we will say she does have office supplies and mileage, because office supplies you need it in the office for it to operate. As a designer, she has multiple things that she needs. And then she has to go to meetings to meet with her clients. So we're going to say she has mileage. Now, Sarah, by having these three top head, remember, heavy deductions. We're looking at heavy deductions. Home office, supplies, and mileage. My income is 60,000, right? Let's create our relationships. Home office, mileage, supplies, QBI. Make it make sense. Make the numbers work for you, right? Now, what do we need to define for Sarah? So her taxable income after deductions are going to be significantly reduced. Why? Because although Sarah did not get wages paid by an employer, she did earn $60,000 from clients. Her home office, which is a max of 300 square feet, magic number here, remember that. 3,200 square feet home I have with my husband. Of that home, I can only utilize max by IRS regulation, 300 square feet. Every year I pay for my home $26,000. Numbers are getting good. Every month as a graphic designer, she has subscriptions. She has a multitude of different items that she has to have. She would say, I have about 1,000 a month of supplies, 12 months, 12,000. Her mileage, on average, Sarah travels a month, I'll say 30-mile radius, round trip, 60. And we're going to take that 60 and we're going to round it to 40, because, well, we're going to do 100 miles a month at 12 months intentionally, because not only does she have the meetings, she has to either go for supplies, she has to do errands to get to deliver to FedEx. She has other aspects, right? So you want to include the 360 view of how her mileage picture. So if she's doing 100 miles a month for 12 months, she have 1,200 miles to claim. So let's do the math. All right. So the math, we're going to go basic. 26 and 12, we already know that she's at 38,000 monetary identified costs. Remember, from this 26,000, we can only do the 300 square feet. So there is a calculation involved there. But I'm just doing estimates at this point. So let's say of that 26,000, we have 38,000 and her mileage is 1,200 miles. They're going to say, "How? I'm going to give her 1,775. Imagine, we're going to deduct, remember her income was 60,000. Of that 60,000, she gets to deduct a 20% of her income. So here we're looking at 775. We're going to do 39,775 deducted from here, right? Oh, wait, I forgot. 20%. I still get to deduct, because I'm a qualified business individual, another 20% from my 60,000 on top of my expenses. So at the end of the day, although my business was profitable, I have gross receipts. I have a lucrative business model, but you're not going to you're going to tax me at a bottom line number of 10,000 because I've justified everything I have. And everything is legitimately valid, right? Because I get to deduct 20% of my 60,000, 39,775. My bottom line will be a rough estimate about 9,000. And that goes over to your 1040 at 8%. Why? This is going to be reported in a Schedule C. It's a form addition to the 1040. Everyone in the US has to file their tax return on 1040. The Schedule C are for us business owners, freelancers, anyone that's 1099. We file an accompanied form to this 1040 called a Schedule C. Our basis to this 1040 is carried by the Schedule C. So these numbers, my bottom line 9,000 is going to be carried over to my 1040 as my income number and creates my basis to the US to tax me. Super complex, super detailed, but after you do this repeatedly, it becomes supernatural, right? And it takes a lot of work to capture these details. So, first tax strategy that I'm bringing over to you today is making sure that as a business owner, you're understanding the tax strategy of what is a deduction that I can qualify for. What are my heavyweight ones for you as a business owner? So it's going to be home office, vehicle expense, supplies and equipment, and this one right here. Because I want to make business. I want to get to 500. That's what you want, an affirmation of $500,000 in gross receipts from your customers. That's how much you got. This is minuscule, because look at it like this. I can make 500,000 in income, but from 500,000, I can deduct a multitude of things. But it just takes time to not do those common mistakes. Not subscribe to Square. Stop using Cash App. Stop using Zelle. Have an established business bank account. Everything's transparent. I have provided you everything in order for you to give to me what I qualify for, which is my 9K income as a $60,000 graphic designer. And that's going to be my first case study. The next one we're going to go into are our real estate professionals. So I'm going to go ahead and clean up our board so that we can cover some of the real estate stuff. Real estate is really, really easy, with the exception that there are some specifics. The specifics are, you have real estate and you have property management. Two different types of individuals. They play two different complete roles, right? Property management, I am a liaison to an investor, or I myself am the owner of these properties and I am renting these properties for a fee, typically known as a management fee. Now, real estate agent usually work with a group under a 1099 arrangement or as an individual. But as that individual, they have a team, a slew of people. They pay commissions, they pay affiliate fees, they pay a multitude of fees, okay? And those fees are going to fall into a different category, and we're going to cover that now. So for real estate agents or real estate professionals, they use what's called a Schedule E, okay? So our form now, we're going to Schedule E. Of that form, what we're going to look at is a few things that are very, very important. We're going to look at these these categories are going to change because we're changing our industry. So with each industry you change over, this changes over. So we started with a freelancer, with a home office, supplies, and mileage. Okay? For my real estate agents, it changes, the game changes. They have depreciation. They have mortgage interest and property taxes. And then thirdly, they carry an interesting one, repairs and maintenance. So from here, I'm going to say, okay, I'm a real estate professional. Now, I'm going to cover a few things under these. So I can depreciate my rental property over time. So if I'm in real estate, my rental property, I can depreciate it over time. My mortgage interest and property tax, that's inevitable. We know we have to pay Uncle Sam his money. We have to pay the county their money. That's inevitable. We have to pay our lender for giving us that loan that may or may not have been favorable based off of the initial terms of the loan. But guess what? I have my property. I have an asset. So this is another item. The other last one is called the repairs and maintenance. Now this one is a fun one because when we have tenants, dependent on the type of individual, it can be the best tenant in the world, or it can be a very challenging tenant, and we suffer a lot of losses. Those losses come from damaged walls, damaged appliances. All of those are considered repairs and maintenance. So with that, those costs, you will also make sure that you document and keep that record because they're now considered a deduction. With that being said, here's our common mistake. So for real estate agents, your common mistakes are always failing to account for depreciation because it just sounds too complex. It's just like, I just don't know where to start with this. Well, guess what? It's easy. I am a real estate agent. My name is John. John has an awesome property on in Griffin, Georgia. It's 60,000. I put it in service. My first client signed up. Tenant moved in on November 1st. You do a depreciation schedule. That day one. Day one of that rental, there's a few documents you want to have. Signed, executed document with the tenant. Signed, executed loan document of acquiring the property. If you have a loan, if you have a deed, make sure you have the deed. Third document with the deed is your depreciation schedule showing your fair market value and the cost depreciating by month. That's it. That simplifies this process because that schedule at month 12 or the last month of that calendar year gives you your amount of depreciation. No biggie. Complete simplicity, right? But what did I have to do? I had to put processes in place to make sure that I get that information from the time I'm making that interaction of or starting a relationship of tenancy. The other thing that the other one is being able to differentiate capital improvement versus expenses. Okay, so capital improvement must be depreciated. Capital improvement covers a property, a physical structure. You're improving the physical structure to add or redo. You're adding another bathroom. And in that bathroom, you actually have to do you have to do structural work. You have to do electrical work. You have plumbing work. All of that all together encompasses what is called a capital improvement. Remember, when you first bought the home, you depreciated for the structure as it was at that time. Anything you've done outside of that, it's called a capital improvement and it's depreciated. So you have to revisit your depreciation schedule established at the beginning, your inception of that rental or acquisition, to now add the value of that capital improvement, which makes it favorable to you, the taxpayer, to deduct as an deduction. Another simple process, but a common mistake we do, is not track it as a depreciation expense. The shelf life or depreciation is 27 and a half years of a property. I can depreciate $13,000 of the value of my property every year as an advantage to me. But because I don't want to put the work into it, I just call it, hey, this year I'm going to just deduct the whole $20,000 I paid the contractor. Where I could have taken that amount and spread it throughout 29.5 years. You have to understand that we control what our numbers look like. Because if you don't give them the full vision of that picture, they won't know what to allow and disallow. And it all starts with you, the business individual. Now, the other thing is, okay, let's get fun with it. John, he earned $75,000 in commission. His name is John. Okay. And John earned $75,000 in commission tax year 2023. And in that tax year, John also owns a rental property. And in that rental property, he got $15,000 in income. This is commission. This is income. All income. Both of them is revenue generated, right? So with that, both of them being revenue generated, he can also deduct. Look at my relationship test. My relationship test, right? My relationship test. Imagine, it just gets better. Like your tax strategy is, I need to make sure that one, I identify what is my industry, what is the form associated, and take action on my strategy, right? And then with John, with being able to write off so many expenses to include marketing, travel. I mean, real estate agents are always busy. They're forever busy. I think they pay the most fees to be a part of multiple unions and organizations, stay up to date with the the magazines, and there's so much involved with high level marketing expenses with real estate. But do you think that all these three could have offset this income? Definitely. Because if John does this 365 days a year, and let's put some numbers to this, 75K is my commission, and then I got 15,000 from my rental property. We know that the commission standalone. Why? You're going to see why. But my rental property directly related to the property, it's just a 1-bedroom studio that I acquired, and it was $150,000. My monthly depreciation is $3K. My annual depreciation is $3K because it's a 1-bedroom studio. My monthly interest is $7K. And my repairs and maintenance averaged on about $3K. Remember, my rental income was $15. Based off of these numbers, $13,000 to operate my profit line. Remember, I'm applying due diligence. I'm being transparent. In order to rent my unit and operate as a real estate agent, I only profited $2,000 from this rental property. But what about the 75K? Favorable. Why is it favorable? He did a Schedule E for the 15,000, but he has to do a Schedule C for the 75,000. Why? Real estate agent gets issued a 1099 by their affiliate broker, or if they have their own established business but under an EIN. So that 75,000 is their baseline to all the marketing fees, affiliate fees, mileage, merchant fees, and they have the most fees. They have fees everywhere, subscriptions. And now he gets to write off all of these under a Schedule C. But guess what? It's not over. Because then he gets to apply 20% off of this for that one. That's 75K as a deduction. And he gets to qualify for 20% off of this. But it's just not over, because this is my Schedule E. This is my Schedule C. If you remember, in our previous scenario, our main form is a 1040. So the data, the balance numbers that we conclude with in these are both going to be brought over to my 1040. And what's my goal? My goal is to transparently disclose all of my operation by the respective forms, what I'm doing, and bring it over to my 1040 and say, hey, IRS, hey, Uncle Sam, I only profited $30,000 as an individual. I took home $30,000. I may have made 75K here from an awesome two reoccurrences of commission, but that 75,000 didn't offset. It only gave me a profit line of 30K. So, Uncle Sam, I'm sorry, but really not sorry, because I only have 30K and I'm single. You're going to take 30K and they're going to give you an $18,000 standard deduction from that 30K, right? And guess what happens? They can only tax you on the difference. And imagine what that's going to look like. 8% of the difference of the 30 to 18K. What are we looking at? Right? We're looking at $12,000. You're going to only get $12,000 worth of taxable income from John. But guess what? John, as a Schedule C, John was able to pay himself. So, yeah, 12K is me, John, personal. This is John, real estate agent, 75K with a 30K payroll. So guess what? I'm in payroll here. I'm getting a 1099 from myself, but you're only going to get 30, you're going to only get 12K out of what I profited it over doing all of this. Tax strategy. That's the strategy. Take the money off of the individual, be transparent, be ethical, but still bring it on over. Now, in saying that, I'm going to go ahead and take us over to our closing. So our closing today is going to be very, very straightforward. As you can see, every industry varies. Every industry has its different treatment. The one thing that they have that forever is going to be the same is this. And what comes from there is your knowledge of, I identify myself as a freelancer. I identify myself as a real estate agent. I'm a nurse. I'm a travel nurse. I need to know what my industry is and what a company form comes with my 1040 for you to properly tax me as a U.S. tax-paying citizen. And the only way you're going to do that is by constantly following up with knowledge. Continue visiting my channel. Continue seeing the sessions as we cover more and more the details and the tax strategies that match your industry. By understanding the specific forms of deductions available to you, then you start putting yourself in an empowerment position to optimize those tax benefits and advantages and those strategies that will help you as a self-employed individual not to fear self-employment, not to fear profiting because you landed a good deal, but how do I make that good deal transcribe to what my tax planning will be? And that's the game changer. Going from worried about taxes that are going to do at the end of the year to planning that out and you controlling what that looks like. And finally, make sure that you consult with a tax professional that is very knowledgeable and familiar with tax laws. Not because they've been in 7 years in business means that they're knowledgeable. Let them give you what you already know. Challenge them, question them. And it's not because we challenge Xfinity, we challenge our electrical company if we see a increase in our usage. We can do the same thing with everyone that that provides us a service. Not because it's an area that you're afraid of, you don't want to dive into it. It has to do with you as an individual, with capturing your financial health. And then most importantly, like, make sure that you keep record. Everything has to be kept. Your records have to be kept by IRS 7 years. You have to store your records. And then lastly, I want to thank you for taking the chance, taking the time to listen to our tax strategy, listening to me, because guess what? That means you've taken the first step to financial freedom. And financial freedom might not be 400,000 next year, but financial freedom looks like defining what it took to get to that 400,000 next year, right? Because you have a story to tell. This is where I started at 75K, and by defining these, I was able to get to my 400K. Thank you for listening in. My name is Yara Thompson. Remember to please visit our channel, subscribe, like, follow. Also visit my social media. You can find me at Ask Yara on Instagram and Facebook. And if you have any questions or concerns, free forum comment. I'll be glad to reach back out to you, or reach out to me at my website, listed on the channel as well. Thank you. Have a great day.